Welcome back. Let's tee up the trading day ahead and bring in our all-star panel. Mark Zandi is chief economist at Moody's Analytics. David Zervos is chief market strategist at Jefferies and a CNBC contributor. And Matt Powers is managing partner at Powers Advisory Group. Gentlemen, it's great to have you all here. David Zervos, I'm going to start with you because as goes oil and energy prices, so goes the rest of the market right now. And it seems to be driving Fed policy, too. Your thoughts?
Well, Morgan, good to be with you this morning on the early side. But yes, I think that's right. Although I would take a step back. We're getting enormous volatility on a lot of headlines that are hard for many of us in financial markets to process. We're not all geopolitical experts. I consider us all mostly geopolitical tourists. So it's a tricky time. But if you step back, it's pretty benign so far in financial markets. The S&P's down 3 and change for the year. The 10-year notes still around 4.25% in yield, not up that much. And the dollar, while strengthening, hasn't gone through some major spike. Looking at it related to where we were in the Ukraine, beginning days of the Ukraine-Russia war, this is a significantly less significant hit to financial markets. And looking at it like what we had last April with the trade shock, which is also a negative supply shock, it's just a little bit more comforting for markets. I know that probably doesn't feel it, but for me, I've been mostly surprised on the pleasant side at how well we've taken this very steep negative supply shock in energy.
Yeah, along those lines, Mark, and I pointed this out earlier in the show, and I'm going to revisit it now. At least before the move higher we saw in oil prices here in the last hour or so, we were up about 49%, 50% in oil prices since the start of Operation Epic Fury, and the S&P only down about 3.5%. Some focus here on the fact that the U.S. is a net energy exporter. That's strengthened the dollar, and perhaps that's created a U.S. market and economy that's holding up a little better than some of the others that we're seeing around the world right now. That being said, at what point does this start to settle in and have bigger, broader impacts on the U.S. economy and perhaps start to raise the concerns of things like stagflation?
Well, I think we're there. I mean, if we stay at these oil prices, I mean, last I looked, we were at $120 a barrel on Brent. That would translate into $4.50, $5 for a gallon of regular unleaded. And just for context, the all-time high was briefly $5 a gallon back in the Russian war with Ukraine in June of 2022. So, you just look at the dollars and cents and the impact on American consumers, and it's the consumer that's going to get hit first. The producers, they benefit, but the impact on the economy won't happen until they invest, and they're not going to invest for a long time. So the hit here is very negative. It's a hit to consumers, and the dollars and cents are quite significant. But as you know, the impact of higher gasoline and prices, higher diesel prices, which translates into higher grocery prices, anything you get delivered at your doorstep from Amazon is going to cost more. That has a very significant effect on the collective psyche. Nothing is more pernicious on people's perceptions of their own finances and the economy's performance than cost of a gallon of regular unleaded. So I think, my sense is if we stay here, $120 a gallon for any length of time, couple, 3-4 months, we're going to be talking about recession.
I want to get your thoughts on this, Matt Powers, especially as you talk about the fact that this is a geopolitical risk premium that's pricing into the markets here, starting with energy.
Yeah, I echo a lot of what David said there. And, I think the most important thing for investors right now is just, recognizing where we are. And to me, I think we're at, and again, I'm no geopolitical expert, but at peak uncertainty levels. And in this environment like this, it's not when you want to necessarily take on more risk. And, we work with individual clients and we have those conversations a lot. But if you rewind just a few weeks, the setup was actually pretty constructive. The economy was holding up, inflation was trending in the right direction, and the labor market appeared to be stable, and the Fed was getting closer to more cuts. So, on the market side, we were broadening out, earnings were solid, and there was a clear path for equities to push higher. But then Iran hit, and then it changed the narrative overnight. So, it's a very different market, I think, than we had a few weeks ago. And you saw it play out yesterday. You saw, stocks sold off after the hotter than expected PPI reading, and investors just headed into the decision with a lot of hesitation. So, it tells you inflation's already in a more fragile place, and even before you fully factor in what's happening here with oil.
Yeah. I do want to shift gears here. Matt, I want to get your thoughts on what is some breaking news right now in real time, and that's we're going to take a look at shares of Alibaba because those are falling. We just got quarterly results from Baba. Sales rose 1.7% fourth quarter. That was below analyst estimates. Net income dropped 66% from a year ago. Operating income down 74%. The company citing increased investment in quick commerce, user experience, technology. That's the reason for the drop. One bright spot, Baba's cloud intelligence group. That saw sales rise 36%. That was driven by public cloud growth, triple-digit gains in AI-related products. China tech trade, that's been making a lot of headlines here this week, but also more broadly, the AI trade, especially as we see Micron under pressure here this morning, Matt.
Yeah, just specifically on Micron, and these are your words from earlier this morning. I mean, they blew it out. They tripled revenue. It's one of the only 10 major companies with positive returns this year. But I think what's happening now is just this maybe like a structural shift driven by AI and these high-end memory chips used in data centers. They're in massive demand, and pricing power has completely changed there. So they're Micron specifically, they're pushing CapEx to capitalize, and they've got 2 fabrication plants going in the U.S. and maybe that's why the shares pulled back, the extent of the CapEx. But I think this could be looked as a positive. But key point here, there is no real supply coming online to meet it, and we're likely in a memory shortage that could last here for a couple of years. Okay, we'll have to see. David, how do you factor that in to the broader conversation that we're having about geopolitics and geoeconomics? And then also the fact that in the background, we do have stimulus here in the U.S. In the form of, tax returns and everything we're seeing with that season take root. And also the possibility that we're going to be spending a lot more on defense. $200 billion is the number being floated by the Pentagon right now. Big question marks about whether lawmakers would get around that number, that supplemental number, which is higher than what we've spent in Ukraine. But again, it speaks to more spending.
Morgan, I guess I would just echo a little bit of what Matt was saying. I think there are some positives in the background, and I'm not going to get too nervous yet about some sort of major demand crash, which seemed to be where Mark was going a little bit. Precisely for what you were saying is that there does seem to be some stimulus on the sides. But I was really taken aback a little bit yesterday by the Fed's rapid increase in its long-term potential growth rate from 1.8 to 2.0. We haven't seen that kind of increase in a quarterly period. I don't think we've seen it go up 0.2 in a very long time. I was looking for it. It goes up 0.1 at most, and it really hasn't been at these levels since we were last talking about secular stagnation. 10 years ago. So the Fed's getting more optimistic on productivity growth. They're getting more optimistic on potential growth being higher, and that this economy can grow at more rapid rates without really generating the inflation risks that people would normally worry about. And I thought that was very good news. Okay. And I think that continues to be good news in the backdrop of a Fed that also gave you some bad news, which was that politics are going to play an ugly role in the next 3 to 6 months with this court case by the U.S. attorney. So I think there are some difficulties with the Fed, but I thought the economic side, I don't want to call it geoeconomics, just the straight economic side, gave me some cause to be rather optimistic.
Mark, I've got 20 seconds left. Last words.
These guys are pretty optimistic. I don't know. It felt like the job market's pretty flat. Consumers are on edge and prices are going up. So buckle up.